Are you sure that the expenses that you are claiming when filing for tax returns are actually expenses? Many businesses have found themselves in a very funny situation because they are turning investments into expenses, and KRA is watching, and at the right time they will issue your business with additional tax assessment that will come with more taxes, fines, and interest. Let me define the difference between these two types of expenses. We have operating expenses, and number two, we have capital expenses. Operating expenses, these are the day-to-day expenses that your business incurs when it is being operated. Think about salaries, rent, cost of utilities like water and electricity, minor repairs, advertising. Think about those expenses. When you incur them, you will still need to incur them the following month. If it is salaries, you will still need to pay salaries next month. If it is rent, you will still need to pay rent. If it is some minor repairs, they will always be there for you to do them. Now, the main difference or the main definition of operating expenses, these are expenses whose usefulness, whose value, whose benefits will not go beyond a period of 12 months. And therefore, when you are preparing the income tax returns for this year, you have to deduct and recover the cost that you incurred with reference to these expenses. Taxable profit, how do we arrive at it? We simply say it is revenue that this business have produced or generated in this particular year. You deduct all the valid expenses, and these valid expenses are only operating expenses. When we come to capital expenses, these are expenses whose value, whose benefits, whose usefulness go beyond a period of 12 months. And therefore, when you are computing for taxes payable, for taxable income, you do not deduct them 100%. Instead, you use the channels that are provided by KRA for deducting such expenses. We have capital deductions, we have investment deductions, and you have wear and tear deductions. Basically, what these deductions enable you to do is to come up with a structure on how to recover these expenses, how to convert these capital expenses into operating expenses, so that you can know what is the value of this capital expense that I can assign or allocate it to this particular year of income. Let me give you a good example. You buy a computer, and this computer will be used by your business for the next 5 years. And this computer has cost you 100,000. So what you do is you divide 100,000 by 5 years, and you realize that each year is 20,000. So the 20,000 is the cost that will be treated as an operating expense with respect to that particular year of income and with respect to that computer. The other 80,000 will be recovered on a basis of 20,000 annual basis for the second year, third year, fourth year, fifth year. And that's how you manage to convert a capital expense into an operating expense. Now, the mistakes that businesses do is when they confuse capital expenses for operating expense. And they do that by claiming 100% capital expenses in the year that those expenses have been incurred, instead of prorating them, instead of allocating them into various years that the usefulness of this asset will be enjoyed by the company. Maybe it is a machine like I've explained, or it is a major innovation that you have done for your office, like changing a normal floor into tiles. Now, when you do that benefit, it has increased the value of your office building, and therefore you should not claim it within that year of income. You buy a motor vehicle, don't claim that cost 100% in that year of income. prorate it. You buy a computer, you buy furniture, the same thing. So those are the mistakes that businesses do make, and they make it complicated for KRA to understand what is which. So KRA eventually, they decide to come and do a tax audit for your business. This is not a good thing. When they do a tax audit, they want to see your bank statements. They want to see the asset register, how you have been registered, how you have been recording your assets. They want to see the suppliers' invoices. They want to see the depreciation schedule, the one that you do enter for your assets. And finally, they want to see the reports that define what kind of repair works that you are doing, whether was it substantial, was it minor repairs. They need to see those additional notes that accompany the financial statements. And when KRA realize that there's some inconsistencies, there's a gap somewhere, and that you have converted a capital expense to be an operating expense, the first thing they do is they disallow that expense. Number 2, they add it back to taxable profit. Number 3, they recompute your taxes. Number 4, of course, they hit you with penalties. And number 5, of course, they hit you with extra interest and fines. So this confusion about how to treat an expense as a capital expenditure or an operating expenditure, it is a time bomb. What do you need to do? What you need to do, for heaven's sake, before you file the next return, ask yourself, is an operating expense? Is it simply helping me to run my business, or is it an investment to the future of my business? Depending on your answer, you know what to do. But if it is still confusing, ensure to look for a tax consultant to guide you through this complex tax landscape that we have here in Kenya. Because KRA will not help you classify your expenses. What they will do, they will issue you with an additional tax assessment, and that will mean more taxes, more fines, more penalties for your business.